In today's video, we are going to take a deep dive into cryptocurrency and how you work your way around it. Now buckle up as I'm going to teach you how to invest in cryptocurrency and why you need to invest right now. But before we get right into the video, welcome to Wealthmatic, your regular dose of crypto, wealth, and millionaire inspiration. Here we talk about the latest news, tricks, and tips in the world of crypto, so be sure to subscribe to my channel. So let's begin this video first with a question: why should you invest in crypto right now? Well, to begin with, Bitcoin has made a huge improvement, coming from a $1 price in 2011, and now we are seeing it at $20,000, $30,000, $40,000. And as of right now, Bitcoin's price is somewhere in the 20,000 mark, depending on the date you're watching this video, which leads us to the next thing that you should keep in mind when it comes to crypto. It's very volatile. Additionally, the crypto space is still so fresh and there's so much more potential with it. It's becoming more and more popular each day, to the point that it has now reached mainstream audiences where people getting into crypto increase every single day. The main thing that makes crypto so enticing is that it works on a decentralized system, which means that the government cannot really act directly upon it. But in spite of that, crypto is also seeing more financial backing from giant companies, which certainly amps up the entire crypto space, making it more reliable and sturdy. Before we get into anything in much more complex detail, let's first talk about cryptocurrency. So basically, cryptocurrency is a digital currency which is an alternative form of payment created using encryption algorithms. It stems from two words: crypto and currency. Crypto is simply a shorter term for cryptography, which is basically the word used to describe the discipline of writing or solving codes. On the other hand, the word currency refers to money in any form as a means of exchange. Now, why is cryptocurrency an important thing? Well, cryptocurrencies were introduced with the intent to revolutionize financial infrastructure. They represent a new, decentralized paradigm for money, where they make it easier to transfer funds directly between two parties, without the need for a trusted third party or middlemen such as banks or credit card companies. Furthermore, crypto networks are also immutable. This basically means that Bitcoin, or pretty much cryptocurrency, works on transactions that make it impossible for any entity to manipulate, replace, or falsify data stored on the network. Moving on to the question, how does it work? Since they operate in a decentralized system, anybody can verify everybody else's money, and these people are volunteers that are called miners, POW, validators, POS, or delegators, which will be discussed later on. Since crypto networks run on a distributed public ledger called a blockchain, there is a record of all transactions updated and held by currency holders. In addition, any user that seeks to make a transaction will need to pay a specific transaction fee, which varies according to each cryptocurrency. So now that I mentioned the term blockchain, let's dive deeper into what it is all about. A blockchain is a decentralized ledger of all transactions across a peer-to-peer network. Using this technology, participants can confirm transactions without a need for a central clearing authority. Potential applications can include fund transfers, settling trades, voting, aka governance, and many other issues. This term is a fusion of two separate terms, which are block and chain. The word block simply entails a block of information, while the term chain refers to new blocks of information that are added to an existing sequence of blocks. Earlier, we mentioned that transactions need to be verified in some manner, one of those ways being crypto mining. Those who are willingly verifying the validity of digital transactions on the crypto network in a proof-of-work manner are called miners. These miners are working really hard to add blocks of information to the blockchain, and they do this by decoding complicated codes, hence the cryptography in crypto, as well as solving problems in mathematics. They do this in order to verify identities, transactions, and any activities in the crypto space. Now, this seems like a lot of work, because it is. But to add on to the additional work, miners also need a strong and robust computer system called a mining rig. And of course, they're going to need a lot of electricity in order to make things work. Crypto mining is indeed a lot of work, but why do miners still race to get the job done? Well, every time a miner is done with their task and successfully adds a new block of information to the blockchain, then the miner will receive a reward in the form of crypto coins. This way, new coins can be added to the circulation, For Bitcoin, the Bitcoin reward that miners receive is an incentive that motivates people to assist in the primary purpose of mining, to legitimize and monitor Bitcoin transactions, ensuring their validity. Now, there are other ways to validate transactions on blockchain, one of these other ways being proof of stake. Proof of stake is a cryptocurrency consensus mechanism for processing transactions and creating new blocks in a blockchain. A consensus mechanism is a method for validating entries into a distributed database and keeping the database secure. In the case of cryptocurrency, the database is needed to verify blocks and transactions that keep the blockchain and thus a cryptocurrency secure. Proof of stake changes the way blocks are verified using the machines of coin owners. The owners offer their coins as collateral for the chance to validate blocks. Coin owners with staked coins become validators. Different proof-of-stake mechanisms may use different methods for validating blocks. At the time of this writing, Ethereum has already transitioned to POS. It uses shards for transaction submissions. A validator will verify the transactions and add them to a shard block, which requires at least 128 validators to attest to. Once shards are validated and block created, 2/3 of the validators must agree that the transaction is valid. Then the block is closed. In a future video, we will go in depth about the differences between POW and POS and talk about the new ways of validation that are being created to verify transactions on blockchains. In light of that, let's head into some of the world's most popular cryptocurrencies that are widely used today. Without a doubt, Bitcoin is always the #1 crypto since it is the one and only original. Since its debut, there are already a multitude of coins that are becoming more and more popular, such as Ethereum, Tether, Cardano, Polkadot, Ripple, Binance Coin, Dogecoin, Litecoin, Stellar, Chainlink, Uniswap, and a whole lot more. At this point, let's find out the behavior of the value of a specific cryptocurrency. Or in other words, what dictates its value? Well, the value of cryptocurrency is determined by supply and demand, just like anything else that people want. If demand increases faster than supply, the price goes up. For example, if there's a drought, the price of grain and produce increases if demand doesn't change. The same supply and demand principle applies to cryptocurrencies. Therefore, to sum things up, cryptocurrency gains value when demand rises higher than supply. However, there are also other sources of value such as brand, utility, and importance. Speaking of brands, one thing comes to mind. It's Dogecoin. This cryptocurrency started off as a joke, but then the internet received it greatly due to its humor and appeal. Therefore, it saw an insane price increase somewhere in the year 2021. And not only that, Dogecoin also amassed more audiences and ultimately became very popular as Elon Musk talked about it on Twitter. Another factor is utility, and a prime example for this feature is Ethereum. Time and time again, Ethereum has proven itself as a beast in the crypto space, even surpassing Bitcoin's prowess in terms of being the more efficient network. Ethereum is a blockchain-based crypto platform that has the power to potentially revolutionize the development of decentralized applications or dApps. Lastly, the factor of importance also comes into play with the likes of Bitcoin. Bitcoin is considered as the most important coin as it is the first cryptocurrency to touch the mainstream population. And on top of that, it is undeniable that because of Bitcoin, other coins are also introduced to the world. Therefore, it's safe to say that Bitcoin is the root of everything we see in the current crypto space. Just like any other investment, venturing into crypto is also associated with tons of risk. First and foremost, you should know that crypto is still a very speculative market. This means that short-term price movements are largely volatile and erratic. Even the biggest cryptocurrencies are not immune to this. Bitcoin, despite it being very established, is still susceptible to the volatility of cryptocurrencies. But when you look at it closely, you can actually consider Bitcoin and Ethereum as the relatively stable cryptocurrencies, as it has proven the test of time and withstood tons of obstacles and challenges. But you should never stray away from crypto just because it is highly volatile. With crypto, it follows the principle of greater risk, greater returns. And when we're looking for greater returns, we are subject to greater risks. It's just a plain old cycle. You should always be well aware of the risk in crypto because we often succumb to the survivorship bias. This is where most people only tend to look at crypto success stories where people have made huge amounts of money out of it and completely disregard those stories who have lost a huge chunk of money. Now let's talk about crypto wallets. Crypto wallets are basically types of software that are linked to a specific blockchain, which will then monitor and execute different types of transactions in the crypto space. You can liken a crypto wallet to your own personalized bank account, but instead of your own personal cash, they are going to store crypto. Every wallet has a public and private key. A private key is composed of alphanumeric characters used to sign off transactions and validate your public key. On the other hand, a public key is basically a mailbox where people from all over the world can send cryptocurrencies to your public address. In general, your public key is your mailbox and your private key is the key to your mailbox. Simple as that. In line with this, there are different types of crypto wallets. You have your hardware wallet, mobile wallet, paper wallet, and desktop wallet. A hardware wallet is basically a device used for offline storage. The next type of wallet is the mobile wallet, just like Exodus and Atomic, which are wallets found as mobile applications. Third type of wallet is your paper wallet, where it is technically a document that has your own keys and a unique QR code. Now, some people argue that this type of wallet is more secure since hackers and thieves cannot gain access to your wallet unless they steal your paper document. And finally, we have the desktop wallet, which is installed on your own desktop. This has more features available to you, which means you work with much more autonomy. There are a lot of platforms for you to invest in cryptocurrencies such as Gemini, Robinhood, Coinbase, and Crypto.com. These are platforms that give you the power to open a standard brokerage account where capital gains are taxed only when you start to sell. These platforms often have smooth user interfaces which are really great for beginners. With that said, how do you work your way around crypto? You're going to do this by doing tons of research. Remember to never rush in investing in crypto and choose to take all the time that you need to fully understand what you're going into. Some fundamental metrics you need to consider are the circulating supply, market cap, network value to transactions or NVT ratio, the market value to realized value, MVRV ratio, Mayer multiple, trading volume, and of course, the crypto's volatility. You also need to look at other obvious factors, which we call qualitative indicators, such as the website, its white paper, creators, contact points, news surrounding the crypto, total addressable market, catalysts, usefulness, and for those who are interested, you can also look into their GitHub. Now let's have a quick run through to the fundamental indicators I mentioned just a while ago. First, the circulating supply simply refers to the estimated amount of coins circulating in the market. Second, market capitalization, or the market cap, is the network value of a cryptocurrency. Third, the NVT ratio is basically the price-to-earnings ratio, which describes the relationship between the market cap and transaction volume. Fourth, the MVRV ratio is a metric that considers lost coins or coins that are no longer in circulation. This follows the formula of market cap over realized cap. Fifth, the Mayer multiple is a metric that compares the current price to a moving average within the last 200 days. Sixth, the trading volume, which represents the total number of coins that have exchanged hands for the last full day. And finally, you also need to look at the volatility, which measures the extent to how the price of crypto fluctuates over a given amount of time. So now let's head on to tokens. In crypto, tokens are units of value that are issued by crypto startups wherein they represent shares of that certain crypto network. Some crypto startups include Ethereum, Waves, EOS, and many more. We have three types of tokens. Number one is equity tokens, which represent the digital shares of a certain company or organization. Number two is utility tokens, which represent the power given to a person holding such a token to make decisions or grab opportunities in a certain crypto platform. And lastly, number three is asset-backed tokens, which are provided by a real commodity with the likes of jewelry, real estate, and other forms of assets. One of the key principles you need to keep in mind when it comes to crypto is that it's always better to hold on for dear life, or simply hodl, as time in the market is better than timing the market in general. In light of this, how much should you really invest? Well, the safest way to start up in crypto is to invest the money that you don't need to live and invest it for the long term. Don't invest more than what you can afford to lose, because crypto is very volatile and speculative. There's no way for us to know for sure what happens, thus it's always a risky investment. And by the way, crypto is also subject to taxes, but only if you have capital gains received as soon as you trade crypto. The moment you sell your crypto or whenever you make money out of it, then you will be taxed immediately. This is one of the best supporting reasons as to why hodling is important. If you hodl, you are not trading crypto often. Thus, you do not need to pay more and more taxes at a constant rate. And that's basically it for this video. Check out other videos on my channel if you are interested in more crypto and money-making content just like this one. If you have completed the video, hit the like button and tell me what you think in the comments below. Make sure to subscribe to my channel and hit the notification bell to get notified whenever I post something new. That is it for today. See you in the next video.